Hi, welcome back to my channel. One of the best ways to build your wealth is to leverage. Leverage means to use various financial instruments or borrow capital to increase the potential return of your investment. You do not need to have all the money to buy an investment property outright. You can put down a small lump sum and borrow the rest of the balance from a bank or other financing sources. The next step is step number 4. It's about finance right. How to get the best financing option for your cash flow property that will save you hundreds of thousands in interest over time. If you are new here, this channel is about investing in cash flow real estate, achieve your financial independence, and make an impact. My name is Korianne, and I am a real estate investor since 2001. And I have achieved my financial independence when I was 35 through cash flow rental properties after consistently investing in cash flow property over 8 years. If you have not subscribed to my channel yet, then please subscribe and then click the notification bell so that you will not miss my future videos. Thank you so much. So let's discuss how you can get the best financing for your cash flow property. Some of you may know that I had a mortgage company for almost 8 years. And I did a lot of mortgages for my clients and also trained loan officers working for me. I know the fundamentals of mortgages and real estate financings are still the same, but lenders' guidelines may change with new rules and regulations over time. You do not need to be an expert in the mortgages or real estate financing, but working with the great loan officer or loan broker can be a great resource to navigate and guide you through the financing process. First, organize your personal financial documents. As you have learned in the step number 1, planning, you may have organized all your financial data in one location by filling out the personal financial statements that include your personal balance sheet and your income statement. Having these personal financial statements will make it easier for you to work with a loan officer to get you a loan pre-approval. A loan officer or a mortgage broker will give you a list of documentation that they need to get you a pre-approval letter. So these are the main items that you can organize in advance to streamline the process and save you time back and forth with the loan agent. You can get the loan pre-approval after you are gathering information outlined in the step 1 planning, because you get to know how much loan amount you are qualified for. That way, you can save time by only looking for properties that you know you are within your price range based on your loan qualification. A real estate agent likes to work with buyers or you investor who is pre-approved because they know you are a qualified buyer and you have higher certainty of closing the transactions. Documents that you will need to provide to the loan agent or loan broker: 2 years of your tax return, a full month of your current pay stubs, the bank statement, some of them ask for 2 or some of them ask for 3 months, all your investment account statements for 2 months or 3 months, personal identification and social security card, list of the monthly debt payments. If you are currently renting, then you will need 24 months of your rental history. If you like the content so far, then can you smash the like button for me? That's helped me out a lot. Thank you. Number 2 is get pre-approval from 3 financing sources. I will briefly share the role for each of these financing sources. The first one is direct loan officer. Direct loan officers are the employees of a direct lenders like Wells Fargo, Chase, or Bank of America. These are the well-known banks that most of us know about. You can get a pre-approval investment loan with them and see what kind of rate that you will get, and then learn about their estimated closing costs that is associated with your loan. Each of these banks will have a dozen of loan products that they offer to their clients. They offer great loan products for A and A- borrowers with a lower rate possible. They may not have great loan products for challenged income or credit borrowers. This direct loan officer can only have access to and can only offer loan products from their Pacific bank and nothing else. That is to say, if you work with direct loan officer at the Wells or Bank of America, this loan officer only offer Bank of America loans. The second financing source is a loan broker. A loan broker does not typically have a tie to any particular lenders, and as such does have access to many loan products from different sources. They are approved to work with many wholesale lenders, even with Wells Fargo, Bank of America, or Chase. They can shop the best rate for their clients among many lenders' loan products. They can assist borrowers with a wide range of profiles, from A to even the most credit challenged or high debt ratio borrowers, and anybody in between. Their fee may be a little higher than the direct loan officer, but they can shop around among all the lenders that they are approved to work with and be able to find a loan product to fit borrowers' specific needs. Some loan broker can get mortgage loan nationwide when they are licensed in those states that they have specified. So if you are investing in cash flow properties in many different locations, or rather US, then it's good to work with approved nationwide loan broker who can assist you as you scale your real estate portfolio. And also, if you have a little challenge with your credit scores, the direct lender like Chase or Wells Fargo cannot qualify you for a loan, then a loan broker is your source. Another third financing source is a loan officer from a local credit union bank. If you happen to live in the state with great housing prices that produce great monthly cash flow, then you should consider getting a pre-approval with a local credit union. Their rates tend to be lower, and the estimated closing cost is also lower compared to other two sources above. Their underwriting rules tend to be more on the conservative side and tend to be favored more to borrowers with great income and assets. So getting mortgages from them can be a simple process for the right borrowers. You should consider getting pre-approval from all of these three sources and compare the rate and their closing costs, and then see which one is best for you. The only cost that you may pay is your credit report fee, and it's below $100. Going through the pre-approval process, you will learn a lot, and you can ask questions to further your knowledge as you grow your real estate portfolio. I have used all these financing sources in the last 20 years. Each project that I acquired had a different investment goal. So I used the right financing for it to to maximize my return and lower my risk whenever I see a fit. Number 3 is decide how much to put down. We all have our own financial objectives and have our own risk tolerance. Some of you may wish to put as much down upfront as you can so that you will get a higher monthly cash flow. And for some of you just starting out, you may want to put down the bare minimum required so that you can keep a cash reserve for another real estate opportunity. The best way to know which option is best for you, you should share your objectives with your loan broker to run a few financing options like a mortgage with a 20% down or a mortgage with 30% down. And then you can see the estimated numbers before you decide which option works. Which one is work best for you? Most investment property will require 20% of the purchase price as a down payment for your first 4 investment properties. And from your investment property number 5 to number 10, you may require putting down 25% or 30% as a down payment. This requirement may change overnight, so you should discuss it with your loan agent. Also, the loan agent will analyze your income and assets to make sure you will qualify for all of these options. I was able to have 10 investment loans with my income and assets, and my husband was able to have 9 investment loans and 1 primary home loan back then. So your loan agent will tell you what you will qualify for once you provide all your financial statements. Number 4 is decide on the loan term. There are many loan terms available to choose from, but the most common ones for investors are the 30 years, 20 years, or 15-year fixed loans, or 7 or 5 years ARM. ARM stands for adjustable rate mortgage. I like to have 30-year fixed loan for most of my cash flow properties because the payment is constant over the life of the loan, and I can plan my finance around that constant payments. The longer the fixed rate loan term is, the higher the interest rate is. For example, the rate for 30-year fixed mortgage is higher than the interest rate for 15-year fixed term. 15-year fixed term can be 1% lower than the 30-year fixed loan term. Why? Because the lender takes less risk with the shorter loan term. Therefore, you pay less on your borrowed money. The payment for the 15 years loan term is higher than that of 30 years loan term because you will pay your 15-year off much quicker than the 30 years one. Most savvy investors who know how to manage debts well like longer loan term because their mortgage payment is lower, and hence giving them a higher monthly cash flow that they can turn around and invest that money to earn higher return by investing in other cash flow and assets or other cash flow and properties. For example, a $400,000 mortgage with a 30-year fix at 3.8%, the monthly mortgage payment about $22.30. And for the $400,000 mortgage with the 15-year fix at 2.5%, the mortgage payment is about $3,034. So the monthly cash flow difference is $804 when you have a longer 30-year fixed loan term. When you do loan term analysis, you will know your monthly cash flow upfront and decide which loan term will fit your financial objective best. Number 5 is pre-approval process. As you plan your financial goal in the step number 1, plans right. Having your financial statement upfront to date will help you to see your plan better and also allow you to make changes or take any necessary steps needed to reach your financial goal. You will save so much time and effort by having your financial plan. As a result of your planning, having your personal statements ready to be submitted to your loan agent will speed up your pre-approval process. It may take a couple of weeks to get pre-approval from 3 different financing sources. Number 6 is always get 3 loan pre-approval before or just right after your offer get accepted. Why? Having 3 loan pre-approval gives you option to pick one that is best suitable for your investment at hand. The pre-approval will also make sure that you can close your purchase on time. At some points, the refinance market may get very busy for some loan officers and in turn may not be able to close your loan on time, so you having a backup plan protect you from not losing the purchase and also not losing your earnest money deposit. Now you know how much you qualify for a mortgage after getting a loan pre-approval from 3 different financing sources. And you also know which financing source best fit for your investment. You are ready to go out and look for good cash flow property in your price range and then secure the best financing mortgage loan term and rate to maximize your return on investment. What you have learned from this lesson is about traditional financing for your investment property. There are many other creative financings for your investment properties that I have not yet mentioned here, like private money lenders, harmony lenders, equity partner, or debt partners that I will share in the future videos. If you have your favorite financing sources that you use for your investment property, then share with us in the comment box below. Sharing is so good for the soul because what you share will help others. Why don't we do more of it? So let's learn, invest, and make an impact. Ciao.